Our first guest is Blackstone's Joan Solotar. Blackstone is the world's largest global asset manager, $450 billion in assets. It's invested in companies such as Hilton Hotels, Versace, and Michael's Stores. Joan Solotar is the person responsible for helping bring Blackstone's expertise to the individual investor. She runs Blackstone's Private Wealth Solutions Group. Part of her job is explaining how alternative assets are different from traditional investments.
If you think about stocks and bonds, which most people buy, on a daily basis through their broker, et cetera, we're more illiquid real estate assets, whole companies.
So longer term.
Much longer term, where we can control the asset and make changes, whether it's acquisitions or cutting expenses, changing the marketing plan, et cetera. And we hold those assets for about 5 years on average, and then we sell them.
So up until this point, most of your clients, most of the firms that you work for, so to speak, are pension funds or university endowments. They're basically institutions with a whole lot of money. But Blackstone recently has tried to make some of the strategies a little bit more accessible for smaller investors, even as much as $1 to $5 million of investable assets, which in the investment world is actually fairly small compared to who you normally serve. Why did you make that decision?
So if you think about it, if you're a fireman, a teacher, police officer, you actually have access to alternative investments in your pension funds.
Yep.
Yes. And we're managing probably a piece of your portfolio. But most individuals have to save on their own for retirement, 10, 20, 30 years. And until very recently, all of that money was invested in stocks and bonds without access to higher returning categories like private equity or certain parts of credit, fixed income, and hedge funds, et cetera.
So I want to stop you there because the reason that the institutions such as pension funds love working with firms like Blackstone is because you make them more money than what normally they could do just in stocks and bonds. So what's the magic sauce? What's the secret sauce? How does that happen?
So there's a real benefit to what we call illiquidity, the illiquidity premium, meaning that if you think about even investing in bank CDs, you get paid more generally if you're willing to tie up your money longer.
Yep.
So that same illiquidity premium exists in other asset categories. And typically, someone who has $1 to $5 million doesn't need to keep 100 cents on the dollar available in a day's notice, and perhaps they can wait a month or a quarter to access that same money, and therefore they can actually earn a higher return.
So we have a lot of successful business owners who watch us here on Fox Business, but $1 to $5 million to just invest is still a lot of money. Who are these people? What do they do?
Yeah, so you don't have to have $1 to $5 million to invest in alternatives. That would be your total investable pool. And the alternatives sit alongside your traditional stock and bond investments, but who are they're entrepreneurs, they're dentists, they're doctors, they're professionals, or they're working folks who really have accumulated savings in, their retirement assets, et cetera, for the long term.
Okay, so what if I'm not quite there, right? I want to be there in 5 years. I'm not quite there. How can I educate myself? What can I learn more about so that I can eventually invest in that way?
So I think the first thing you want to do is figure out what your goals are, what you're trying to achieve, what your spending needs are, and then think about, do you have enough regular income? Are you trying to generate more cash yield than you are today? And so reading up on areas like private REITs or
real estate investment trusts, just for people who are really beginning.
Yes, real estate investment trusts or credit products that are floating rate, which I'll explain, where you earn a higher yield as interest rates go up, because we're in a period now where it feels like interest rates are rising. Would be two areas to start.
You have an amazing personal story. You are a New Yorker, a native New Yorker. You grew up in Queens, but your family has a much longer history than that. Fill us in on that, if you don't mind, and tell us how that informed and shaped who you are now.
Sure. So I did grow up in Queens, and my dad was a Holocaust survivor. He migrated here from Germany. My grandparents enrolled him in vocational high school so that he would be able to get a job. He was then drafted into the military, and when he came back, he felt like he couldn't go to college. He needed to work. So he was never a large earner. And when I was in elementary school, my mom went back to work, and with no real business skill sets, she found a mentor who trained her, and ultimately she became an insurance underwriter. She worked much of her life till she was 75, actually. And so I never questioned that I would have a career, that it was important to be independent financially, and she loved what she did. And so I always had just a great outlook on that.
So they must be so proud of you, of course. What did they want you to do? Did they have opinions about your career?
I think they just wanted me to get a job.
Yes, every parent alive can identify with that.
They didn't. They encouraged me to do what I really wanted to do.